welcome. All right, Mr. Colin, what's going on, everybody? David, Sandy, Gary, welcome. I think Gary, this is the first time I've seen you on here, buddy. Good to see you. Um, all right, let's hop into it. So the whole idea here is to make investing a team/community sport, because oftentimes Colin and myself are having conversations every single day that it's like, oh, I wish this other family over here would hear that, and they had this question. So we try to surface those so we can actually have real conversations about them. If anybody has any questions, raise your hand either physically or digitally, and we can unmute your mic and you can ask us live. Colin, let me throw the mic over to you because there was a topic that came up recently, and why don't we kick that topic off?
Cool. Yeah, you got it. So as most of you probably know, I think it was a little over 2 weeks now, right? There was a real scare on a Monday in the US equity markets, but it was really kind of ramifications from a Japanese downward spiral that kind of rivaled or mirrored Black Monday back in the 80s, right? So if you guys can remember back in the 80s, some of you were invested at the time. The market was down, 20+% in a couple of days. That actually happened in Japan just two and a half, 3 weeks ago, right? And because it happened over the weekend, just because of the time differences, um, by time Monday morning rolled around, there was a lot of fear and a lot of panic in the U.S. investor and retail market, right? So there was a quick blip. I think it was kind of a rough day. The market was down 3 or 4% that day, and a lot of additional fear was kind of baked into the storyline of what was going on over in Japan, right? So I just can lay it out real quick what happened in Japan, how that may have affected the U.S. markets, and then ultimately where that leaves us, right? Because I actually don't think it's a good idea to make investment decisions based on the headline of the day. You will be in a downward spiral of fear, panic, and fear investing if that's how you behave. But we'll unpack that and get there in due time, right? So what was happening over in Japan was a lot like where we were at in terms of an interest rate environment for the past 10 or 15 years, right? As most of you recall, the interest rate environment in the US was extremely low, right? You might get 1.5% if you were lucky in terms of an interest rate on a CD or a bond or something like that. Well, over in Japan, it's been that way for a long time, right? Near zero interest rates and even at times zero interest rates. So what some large institutions and very, very, very high net worth individuals were doing they would borrow or margin out, right, Japanese yen, right, their currency at 0% interest, convert it to, let's call it the US dollar, and then take that money and invest it in something like a United States Treasury bill that would earn 4.5%, right? So borrow at 0%, convert the yen to US dollar, invest in a Treasury bill to quote unquote guarantee yourself 4.5%, right? All sounds good, right? All sounds intelligent until it's not, right? So what happened was Japan just within the last month increased interest rates and margin called all of those massive loans, those dollars that they were handing out, and a lot of people weren't prepared for that, right? So the institutions, the very, very high net worth individuals, they had to sell off maybe part of their stock portfolio or real estate assets or something like that to come up with the money to pay back the money that they borrowed from the Japanese government, right? So that's what was the triggering event for a 25-ish% downturn in the Japanese market. And because we're a global economy, there was ripple effects in the United States equities market, at least temporarily for those first 2 or 3 days of the trading week. However, as many of you probably know now, right, markets have been very strong over the past couple weeks, and that seems like almost a distant afterthought. I think the reason that we wanted to chat about that today was just another opportunity to remind us that if you panic or knee jerk react to the news story of the day, right, what you ultimately end up doing is stepping over the dollar bills for breadcrumbs.
Yeah, I think all of that's well said. And one thing to consider is, and sorry, I'm always the nerd who brings the graphs. Let me share some graphs with you because I think it's really important to observe these things. And I won't spend too much time on it because I can put people to sleep with these types of things. But let me pull this up. I'm actually pretty proud of how the United States has handled inflationary policy and monetary policy over the last few years. I also know that there's going to be critics. It doesn't matter what you do. There's going to be critics on both sides of the ledger. But if you look at a situation like Japan and we look at their core inflation rate, as per this graph, you look it's at its 40-year high. So if you don't take proactive steps towards tampering down things that are getting out ahead of the economy, then you're going to pay a very large price. So as Japan had to do and increase interest rates, we did this a while ago, and we did it in a very sharp manner. And I was actually happy with what Jay Powell did. And he literally said in Jackson Hole, not too long ago, I guess going on a year ago now, it's like, we're going to experience pain as a result of this, because anytime you increase the cost of capital, where you're going to increase basically the cost of capital primarily for businesses, and that's going to hit, it's going to hit employment, et cetera, et cetera. But if we don't voluntarily take the medicine now, then we're going to pay the price for sure in the future. So Japan's kind of going through that. I could show you graph after graph after graph. It's actually a great time to go on vacation to Japan right now because you can get a lot of the things for pennies on the dollar. But right, it's comes back to the basics. If we don't practice the pain of the discipline, then we will unfortunately pay the price of the pain of regret, and we don't want to do that. Anything else to add to this?
Just to kind of put a ribbon on it. The reason that we wanted to chat about it is not because we think that this is a superior or extremely important event to talk about. It's just the most recent one, right? It's not that it was nothing. It's that I'm not sure how these types of knee-jerk reactions and panic selling based on what happened in Japan, right, really affects your guys' individual, customized retirement plan, making sure that you don't run out of money before you run out of days on the earth, right? So I think the reason to bring up current events is to always put them in perspective relative to what we're trying to accomplish. And almost always, not always, but almost always, what they're talking about on CNBC or Fox Business doesn't really impact your retirement strategy the way that they're going to make it sound, right? So we always welcome these discussions of, hey, I heard this on on the television, or coworkers were talking about this at work. But we will always do our best to redirect the conversation of, okay, well, how does that impact us personally? And that's why we wanted to talk through, that there was a panic, it was an overreaction, and the reason we stayed the course is because we can't react to whatever the news is going to bring up to tomorrow, or else we're ultimately doomed.
Yeah, and to add to this, if for the nerds out there like myself who want to understand this at a deeper level, essentially what's happening with the Japan trade is you're looking for an arbitrage, right? You're looking to borrow money at a certain rate, and you're looking to get a certain rate of return on that borrowed money. Now, if you keep it at the simple level of I borrow money at zero, just to make an extreme case, and then I go and I invest the money in the U.S. Treasury and get 4%, then I have a guaranteed 4%. Here's the problem: most people are not going to do that. Like, the people who are actually going to be executing these trades, they're not doing it that way. They're going to say, who cares about the 4%? I want to borrow at zero, and I want to make a bazillion percent on top of it. So I'm going to invest in things that are more speculative in nature, higher return in nature, et cetera, et cetera. Then on top of it, can I add even more leverage to it? So you get this sort of like multiplicative, exponential, compounded effect as a result. If you look at something like in 2008, this is exactly what happened. You had leverage on top of leverage on top of leverage. And what we tell investors constantly is, like, get back to the basics. Think about the triad, right? The what I call the evil triad for investment behavior, which is greed, fear, and envy, right? If you can stay away from those three emotions, right, and stay put, stay the course, operate a fundamental plan, you will be golden. I won't call people out here by name, but there are several clients on here who have been with us for many years, and they've stayed put, they've stuck to the fundamentals, and they've done very, very, very well. Anyway, let's move on. I actually think it was a good rehearsal because when we talk to investors, it's like, look, we know there's going to be a storm and you have the chance right now to build the ark, right? We're in really good times. Build the ark now. And the size of the ark is going to be directly proportional with the safety, right? The ability for your portfolio to handle the storm. And what we're telling a lot of investors right now is like, hey, while the getting is good, let's reallocate towards heavy cash positions, just being expressed as a multiple of number of years of your expenses. So if you spend $100,000 a year, let's have between 2 and 5 years of cash equivalent reserves in the form of whether it be treasuries, money markets, et cetera, right? So that when, not if, when a recession hits, because at some point it will, because our economy goes in cycles, right? We will have more of a self-insured position. I'd rather you guys do that than us pay insurance provider because then it will be a cost to you, right? If you're in the position to self-insure, that's my personal recommendation. The downside is for some investors, it's kind of stinky. It's like, well, I want the max return. It's like, yeah, but we have to build the arc first so that you're protected. If we raise the floor, then we can focus on raising the ceiling. If you look to the Warren Buffetts of the world, they stick to the basics, they stick to the fundamentals. One thing to consider is hedging market volatility. Number one, you have a strong cash position, which by the way, when we say things like, oh, you put that money on the sidelines, it often gives the illusion that it's like, oh, that's not earning anything. Well, ideally you put it in cash equivalent positions that are actually earning something, right? So always remember result before return. What result are we trying to accomplish? Then we find vehicles to meet that result and have an efficient return simultaneously. Um, and then not getting distracted by your neighbor who just invested in this gold shiny object and apparently they became a billionaire overnight, so they say. So in addition to that, the cash pile can also be used as a Swiss Army knife. Okay, opportunities come up in the future, and those opportunities could be in the equities market, it could be in debt markets, it could be in the real estate market, it could be in a private business venture market, right? You then are the one who has the reserves to do it. Always remember in 2008, literally most of the top banks went to one person. This was Warren Buffett. If you ever want to read some really good, like, I don't know, dramatic literature that's real on financial markets, there's a great book called Liar's Poker by Michael Lewis. He's one of my favorite authors. Just absolutely outstanding, like in story form, and you can still like onboard a lot of financial education simultaneously. But in there, they talked about some like private conversations between, some of the partners at Solomon Brothers and Warren Buffett, how he helped them, blah, 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 et cetera. So anyway, really good stuff. Colin, anything else to add to this particular topic?
Yeah, no, just to reiterate, hindsight's always 2020, especially for the investors that feel like they're losing out by having money in cash or cash equivalents. It's easy to look back now and say over the last 5 years, I could have, doubled my money in the equity markets if I would have just had it all in the S&P 500 or in equity funds. Well, that you're zooming out a little too far, right? Because when we remember what happened in March of 2020, or when we remember what happened in 2022, yeah, was it 2022? Yeah, 2022 when the market was down 20%, right? During those moments, right? That's the reason that we have a treasure chest full of cash and cash equivalents. Right? I think Wes said it best when he said result before return. It's a purpose conversation, not a rate of return conversation, right? The purpose is when we need $50,000 and the equity markets are down 20%, we don't want to create a double whammy, right? We want to go to our cash and cash equivalents to get our lifestyle and expense needs and be opportunistic at the same time with any additional cash we can spare to buy while equity prices are on sale. It would never happen at a grocery market where you would panic sell because the groceries are 20% off, right? That's the time to be opportunistic. But the only way that you can do that is if you have a strong enough moat around the castle.
Yep, 100%. All right, let's hop into some economic data if you guys don't mind. Just want to kind of paint a picture of what's going on right now with the economy as we've increased the cost of capital, aka increase the interest rates, et cetera. What that does, that's not widely talked about because it's kind of an icky topic, is okay, well, what does that do to unemployment? What does that do to people's bank accounts? Um, want to bring to the surface of things could be starting to get tight with the average consumer, and it might be something that we want to pay attention to. So I just pulled up some economic graphs here. If you look at, let's see, you guys can see this, right, Colin?
Yep.
Right. So job creations in the US since January 2022. Then if we go down and you look at unemployment rates and you see, right, that we're starting to increase unemployment rates as of July data. And then you look at the year over year percentage change in average hourly earnings in the US. You're starting to see some of these underlying like trends surface. And know that a lot of short-term market prices come back to groupthink and market psychology, and like some of these stories can get perpetuated, which can impact your finances in a real way in terms of like your values and everything. So this is just to reiterate the point. At some point, we will have a recession, and when I say recession, I mean that in the statistical right like definition, right? 2 quarters of negative GDP. Realize that it's only a fraction of those recessions that no, are probably the recessions that you might be thinking of, like the Great Recession of 2008, et cetera, et cetera. So hard to see that stuff when we're in good times, but this is when we want to build the moats as we've been saying. Also, and I couldn't find a good graph on this. If we look at like COVID relief programs and people getting money right sent from the federal government, um, all the data set that I see is that money now for those people has basically run out. So now you're starting to see, from my understanding, I think you're starting to see credit card debt go up a bit. I couldn't find a good graph on that either. But you just start to see some of these these lily pad pieces of data starting to come together. And it's just something for us to keep our eyes on. We're also heading into a presidential election. But let me pause there. Colin, let me throw you the mic. What's your perspective on this underlying macro economic data?
Well, I think you said it best when you were discussing what Jerome Powell at the Fed. He said we're going to kind of have to take our medicine, and this is just a statistical representation of some of the carnage that he was referring to, right? Your hourly earnings are down, right? Unemployment is up. You start to see, like, I think you referenced it, Wes, right? Credit card debt up, et cetera. I've heard a couple earnings calls from, like Lowe's and Home Depot over the past couple weeks that said the consumer spending they're starting to notice trends that it's down. In a rising interest rate environment, that is very, very likely, right? So, I do think there's a good discussion here about what all of this is kind of hinting towards, which is the inflation piece, right? It's why the Fed's been doing their work to hopefully tame this, but that doesn't, we can't lose sight of like the short term carnage. I would imagine all of us would agree on here that it's been a bit more of a cash crunch when you show up to the gas pump or to the grocery store or trying to book a vacation or any of those things, right? So, uh, and I'd love to, yeah, if anybody disagrees with that, definitely let us know because, yeah, that would be a new perspective for us, and we're always open to that. So yeah, I think this is simply us starting to take our medicine, and does that mean the bottom's falling out and the doomsday world's going to end scenario is upon us? Not necessarily. I think we've navigated it as a country, as an economy pretty well up to this point. And I'm still hopeful that things will continue in a solid direction in the markets, not just short term, but definitely long term. But yeah, again, I would just reiterate, we are starting to feel the brunt of what some of the economic policy that's been put in place. We're seeing the results of that, and it's starting to show up in some of the statistical data that Wes shared with us. And if you tune into the to Fox Business or CNBC, they have plenty of information on that as well.
Now, I think it'd be a bad move to say, okay, well, let's conclude that, oh yeah, we're heading right into a recession. Let's put everything in, under our mattress, because I recently got a call from my family just to illustrate the example. And I got word that my grandmother, who's maybe the most stubborn woman on the face of the planet, she also is one of my best friends. So I'm not talking trash here, but um, one of my family members told me that my grandmother's losing weight because she's not eating. And I said, well, why isn't she eating? And they said, well, because she doesn't have the money to buy food. Now, this was the first time hearing this. I thought that there was plenty of food in the house. I had no idea. So I sent over groceries the next day. She calls me yelling at me because she doesn't like any help. And she said, and by the way, I can't do anything with the food. And I said, well, why is that? And she said, because my refrigerator is broken. So I said, well, your refrigerator been broken? And she's like, well, about 4 or 5 months. So I really like this is the problem if you over index on, well, I'm just going to put everything under the mattress. Inflation, most people have no idea how impactful inflation is to the extent of I've got some really good clients and friends who are actuaries. To the extent of entire pension systems have been discontinued because of that number. Age, life expectancy increasing and getting inflation numbers wrong. If you look at inflation numbers, sorry, my computer does these freaking balloons. I got to figure out how to turn that off. In general inflation, CPI is measured between 2 and 4%. Like if you look at any finance textbook, that's usually the number they use. I would challenge anybody on this phone call to tell us that their inflation number lands in that zone. Almost every single family that we work with, their inflation is easily double that number, easily, especially if you live out in California. So I could tell you that alone, right? If you go from 4 to 8%, I know that sounds so obvious. A lot of people are like, oh, it's just 4%. No, it is 100% different, right? If you're going from $4,000 of expenses, let's say, to $8,000, that is 100% increase. It doesn't take too many years of negative compounding on your capital to destroy your finances. And the problem is like an invisible poisonous gas. You cannot see it, you cannot feel it until it's too late. Right? My grandmother just wakes up one day, a couple of years ago, and it's like, huh, right? Like I'm noticing not a lot of, right? I'm not saving as much from my pension and from my social security. That's weird, right? Like fast forward another 6 months, another year, it's like, oh wait, my savings are going way down. And by that point, you're done. And I promise you guys, I've thought about this a lot. And I'm not a tinfoil hat guy, as you guys know. I'm purely data driven. I do believe we are going into pretty historic potential crisis for the general American who who is just demanding to retire at 65, who only has $300,000 in their 401k, and they're going to live for another 25 years. And I don't know how you solve for that. Like I really don't. And you run Monte Carlo simulations that say, okay, well, Mrs. Smith's okay. She lives in Arkansas and she only spends $1 a day, right? Like I know all about Monte Carlo simulations. I could tell you they're actually not sophisticated at their core. They're very rigid. And if you're factoring it, it's only going to be as good as the assumptions that you put into it. And if you're putting a 3% assumption inflation rate in there, I can tell you right out of the gate, it's a flawed model.
I don't want to make this sound like the dark at night, right? But it is our job to have these conversations. Another theme kind of baked in there that we've heard quite often is, oh well, I'm not going to live till 85 because nobody in my family lived till 90. The data disagrees with you pretty significantly, right? The life expectancy continues to increase year over year, and this is prior to what's probably one of, if not the largest breakthroughs in medicine in my lifetime, which is going to be some sort of artificial intelligence insertion into the medical field, which is very likely to revolutionize it in a very, very positive way for human beings, right? So I'll give you an anecdotal story. I just turned 32. From the time that I was 7, my great aunt, who just passed away at 102, told me that this would be the last birthday that we shared together, right? I was 7 years old. I just turned 32 for a quarter of a century. She told me this would be the last Christmas, the last Easter, the last Thanksgiving, et cetera, et cetera. And she lived. Do I think all of everybody on this call is going to live to 102? I do not, right? But my great aunt, who worked in a factory for 40 years, who sunbathed with cooking oil, right, who never worried about working out or what she was eating a day in her life, right? It just takes it being you for that to be something that we need to plan for, right? So that's another theme baked into like, oh, well, I want to spend now, or I want to give to kids now, or I want to do all these things now. Again, multi-person, multi-decade retirement. We have to be very, very careful about how we proceed, because I'm not saying this to scare you, but we are going into uncharted waters, and we think we have the
Yeah.
math on our side, but we do have to be careful about the way that we navigate a new territory.
Yeah, and this is why it comes back to we never want to confuse, right, the nuances that we're talking about. When we talk about treasury holdings, cash holdings, et cetera, that is for the protection mechanism. But I am very much of the belief, and the guys are with me on this one, right? Like owning equity stakes in private business, public companies, and real estate, right? Like, because at the core of capitalism is an exchange of value at a fair margin. And so if you either are working for the company that's doing that, or you own the companies and or pieces of real estate that are doing that, then you'll be compensated commensurately with the inflation that's being caused. I don't know how you accomplish it any other way. Like besides like lottery tickets, speculative style of investing, but like that's not a plan. That's a lottery ticket, and screw lottery tickets, you know? So final piece here just says this might be fun. But I'm not a political person. I do care what happens with fiscal policy. So I just want to bring to light. Has been recent conversation of, and I'm not going to name politicians. You all probably know who I'm referring to. But there's been a proposal on the table of like, basically fixing prices at the grocery level. Um, and you guys vote obviously however you want, but I just want to bring some data to the table because this has been a common conversation I've found myself in recently. And look at McKinsey did a great study on grocery store margins and where they've been over, let's say like, relatively recent history. And from what I can tell, there's not this like price gouging situation that's being marketed out there. Like the grocery business operates, put it this way, I would never get into the grocery business, right? The margins are already razor thin. Inventory management is basically impossible. Um, so kind of price fixing, which puts even more boundaries around it. I don't know if that to me seems more of like getting blood from a stone sort of a situation. Anyway, again, I don't want to get political, but it's just to actually surface some of the actual data behind this stuff rather than saying, yeah, like eggs have gone up too much. So, right, like let's fix the prices. I'm a huge fan of capitalism, and I think the more like clause and boundaries we put on capitalism, I think we start to get more socialistic in nature. And and my personal point of view is like, I'm not a fan of that. I think you let competition do its thing. You let free markets do the thing within reason. That's how we build wealth over time because it incentivizes human beings to create solutions for existing problems. And that's how the US, only representing 4% of the world's population, is able to create such a disproportionate amount of value across the world. Final words of wisdom, Colin.
Oh, thanks again, guys. No, well, real quick, I happen to agree, right? Surprise, surprise. I think it would be a devastating blow to, believe it or not, the U.S. consumer if we start to price gouge, or I'm sorry, if we start to use price gouge as a fear tactic to limit the price control ultimately, right? Um, Words of wisdom. Yeah, if you ever hear these things outside of this and you want to ask us about them on a roundtable discussion, we'd love to hear your input, your feedback. Let us know what's valuable and let us know what might not be that needle moving for you guys. Sometimes we think we're talking about topics that really strike a chord. If that's not the case, please let us know what is near and dear to you so that we are making sure that these are valuable discussions, because the last thing we want to do is get on here and ramble about things that our clients aren't much concerned about, right? So that would be my once again my kind of battle cry here to wrap up the roundtable.
Yeah, absolutely. And to put a final cherry on top, if you're interested in how the capitalistic structure incentivizes human innovation, there's a phenomenal book called The Rational Optimist by Matt Ridley. I'm probably going to read it again sometime here shortly, but just one of those absolutely groundbreaking books that actually talks about the underlying data of how not that we will always have problems, but how the capitalistic system has solved those problems, whether it be peak calories or peak oil or et cetera, et cetera, et cetera. He goes throughout history and shows that yes, that those were problems, and here's how we solved them. And if there are always going to be problems that exist. We might not have solved them yet, and some of those times because the incentives have not gotten large enough to the point where they will be solved. But in my view, I will absolutely bet that they will be solved. Anyway, love you guys. Thank you.